Alrighty, welcome everybody. My name is Richard Hoback. I'm the Ollie site assistant for this class. I'm basically just here to help everything run smoothly on the technology side. I'm here to help answer questions and manage hands as well. This is the retiring singles class, so if you're not supposed to be here, please find your way out. If you are supposed to be here, this is the right place to be. I do believe Linda is going to be the first one speaking, so I'm going to go ahead and pass it over to her.
Thank you very, very much, Richard. And I just want to welcome everybody. I so appreciate your time in listening to what we have prepared for you. This certainly is not all inclusive, but we wanted to touch on some of the highlights of what to expect as you move into the transition of retiring. So I've put together a panel of experts in their field to help guide you and to provide you with resources that that you might find very helpful in the coming days, months, and years. So one of the things that my assistant pointed out to me just this morning was, you really didn't do a very good job of explaining the layout of the classes. So what I wanted to do was take a moment and give you an overview. This is the first of 3 classes. Today, we will cover financial day-to-day basics, and that's a very, very broad overview of how finances run, just to make sure that we're all on the same page as we move forward. Then I have my next guest, Josh Hummer, is an attorney that I have worked with for quite a while. He's an outstanding resource to me and to you as well. He specializes in estate planning, elder care and elder planning, and estate administration. So he covers your need for wills, trusts, powers of attorney, advanced medical directives, and just about anything else that I can't think of, because I'm not an attorney and I don't have to. So anyway, Josh, thanks very much for stepping in here. Is there anything else you want to add to that introduction?
Nope, that's great. I think a lot of the focus today is going to be on taxes and some of the changes that are coming down the pike related to those.
Excellent. So that leads me to our second speaker, Brian Kling. He will be covering tax information. Brian Kling is with Yount, Hyde & Barbour, a major accounting firm in our area. And they take a very proactive approach to tax planning, which I find hugely beneficial. Their goal is simply to minimize taxes in every possible way that is legal. So I certainly support that position. So he will be popping in towards the closer to the time that he will be speaking. So what I wanted to do is share with you some thoughts. Let me just share my screen here. Oh, sorry, bear with me just a moment. Can everyone see this, single and planning for retirement? Give me a nod on that. Okay, great. So just move this out of the way so I can see. What we want to talk about today is, as we move into retirement, it may be that most of our life or part of our life, or perhaps none of our life, we had planned on retiring with 2 incomes, with 2 Social Security statements, with dual retirement, which is typical, by far not as prevalent as it used to be. But what happens when all of a sudden those plans have shifted and you find that you are retiring on your own? So the first thing that I talk to all of my clients about is a monthly budget. So we're just going to jump right in here and say, a lot of us are, comfortable enough to where we don't have to rely on a budget to make sure all of our bills are paid. But there's a whole lot of other reasons why budgets are important. And so I'd like to just touch on that. Essentially, why make a budget? Why is that a tool that I find so very useful, and many of my clients do? The first is it gives you financial control of your expenditures and your income. So you are brought to the forefront the importance of being on top of exactly how your money is coming in and how it's going out. And it's very, very common for people when they first sit down and do a budget to be astounded at some of their expenses, or perhaps be surprised at what their income actually is. And then they'll often say, well, I wonder why I'm not saving more. Well, that is really the purpose of a budget. It's really to kind of nail down exactly what's coming in and what's going out. It also helps you monitor your goals, so that if you have goals that are focused on spending, which most of us do, that vacation next summer or a new car, it helps us monitor how close we are getting to those goals. And lastly, a spending awareness. I can tell you some stories here. I guess the most recent example of this is a couple that I was working with, and we were talking about their budget, and I noticed that they had a rather high expense for their car insurance. And I quizzed them on it, why is this so high? And he said, well, I've been paying it for so long, I really don't know. And I said, let's tap in and see if we can do a review of your auto insurance costs. And when he did, he realized that 15 years ago, he had put his mother on his policy as another driver when she was visiting, and he never took it off. So he had in fact been paying for insurance on somebody who hadn't driven his car in 12 years. So that's, kind of, hopefully that doesn't happen to many people, but that situation happens to many people. We often have a situation in which, and especially whenever we turn our bill payment over to our bank. For example, we have auto pay on many of our bills. It's easy to lose track of them. So an awareness of what we're spending our money on can be very, very helpful. So the next part of making a budget, and the next reason why it's a valuable resource, is that once you have built your budget, you can identify expected and unexpected costs. We all, nobody likes bad surprises. Some of us don't like surprises at all, but identifying costs as you go forward, and also being able to budget for costs that may or may not happen, can be helpful to make sure you don't derail. Because let's face it, the reason that we have control over our finances is to eliminate debt. That is, debt will derail a retirement plan faster than just about anything I know. So part of our budget, what we want to do is create a cushion for unexpected costs. That sounds kind of backwards. I mean, if they're unexpected, how do we know about them? But we do know that, if we look at our history of spending, every once in a while we have to replace our car, or we have to maintain our roof, or things of that nature. So we want to make sure that if we have a cost that we don't know when it's going to hit us, that we have a way of budgeting for that, so that it doesn't go into a debt category on our balance sheet. So let's talk about on our budget, let's talk about income for a minute. So we have two primary categories for income. We have fixed income, which is your pension, Social Security, if you have any annuities that are paying out, rental income, let's say from a property that you bought and are using it for retirement income. These are all expenses that we can expect to hit every month or every quarter. Bond income, for example, if that's something that you have as part of your portfolio as a way of utilizing your income needs. So these are fixed income amounts that we can pretty much tell you what they will be, going forward. Now, Social Security obviously has a COLA. Some of our pensions have COLAs. Some of our annuities have COLAs. And our rental income, we certainly have some ability to increase. But again, these are income sources that have a finite amount of dollars tied to them. And then we have variable income. Some of us have that. And that could be investment income, dividends, and interest. One thing a lot of people are not aware of is when you have a portfolio, you can ask your financial advisor to flip the switch and make the income from that portfolio payable to you, as opposed to accumulating in a cash account in that or being reinvested. So so that might be a way to supplement your income, but it varies by holding. So some of them may pay quarterly, some of them may pay annually, some of them may pay monthly, but it will be a different amount each month if you choose to do that. Part-time employment is not unusual either. A lot of people, find this beneficial to not only supplement their income, but just to have a way to engage with people or to feel productive and to give back in some way. And that could be, if it's seasonal or if you just want it for a temporary amount of time, that would be considered variable. And then sometimes we have investments that mature and we have a payout on them. And this could be a bond, it could be a CD. Usually it at one time was a fixed income, and then then you might have a moment in which you get all of your premium back. So that would be variable income based on the timetable of the maturity of that investment. Expenses, on the other hand, we have 3 categories for those. So the first of which is your fixed expenses. And we all, know those checks we stroke every month. We pay our mortgage and our rent, our insurance costs, car payments, lawn maintenance, estimated taxes. Some of us pay, and Brian Kling will get into that a little bit more, but it could be time that as we aren't getting a paycheck anymore, and we're not having taxes withheld from our income in most of our retirement income sources. Possibly you could request it, but some of us don't do that. So then we have to switch over to paying estimated taxes, which are quarterly. Even though it's quarterly, we still pretty much know at the beginning of the year what those payments are going to be. So those are considered a fixed expense. Tithing is another thing that some people budget for, and they know exactly how much they desire to contribute to charities. And then also on a fixed expense, I'd really like you to consider savings as one of those. So what we want to do is be completely in charge of and in control of how much goes into our savings accounts. And then we want to have goals set up for how we want to spend our savings, at what triggers a spending event, for example. When do we hit our goals that allow us to move money out of savings, but always consistently be putting money into it is very important. The next type of expense is what we call variable spending. So that can vary throughout the year. Utilities is an example of that. We often have higher utility bills in the summer than the winter. Car maintenance is something that we, can vary depending on what our favorite mechanic will tell us is wrong this month. And clothing, if you have an event that you want to go to and you want to make, to re-wardrobe, that's a variable expense. You have complete control over that. The next set is discretionary, which falls sort of into that category, but these are sometimes decisions made based on when I can afford it. So, and that's something that we're going to talk about. Our second class, we're going to talk about spending strategies. What's the best way to, what's the best withdrawal strategy for you? And this is one of the things that come into play. So for example, on our spending categories of travel, that's something that we can do, let's say when the market is up, or when, or how we travel might make a difference as far as how our investments have performed. For example, we can choose whether we do it or not. Entertainment is another one. Dining out, I know during COVID, a lot of us got a lesson in cooking. But for some people, dining out is is something that they enjoy and plan to do monthly. That doesn't mean that that those costs are the same, but that just means that you can simply have full discretion on when you choose to spend that money. And gifting is another one of those that falls under that category. Personal care, you can sometimes decide. I've certainly participated in conversations, and I'm not talking about haircuts. I'm talking about knee replacement surgery, or, different, hiring a personal trainer, or any number of things that we may want to spend, a not small amount on. So one of the best resources that we have in our spending and in our income come in the form of statements. We get our bank statements, we get our investment statements, we get Social Security statements, we get annuity statements, pension statements. So a lot of times I have discovered that people will tend to throw them in a box that is marked statements. So I highly encourage you to become friends with your statement. It's amazingly simple once you have the key to understanding them. So what I want to do is kind of talk about before we even open our statement, just in how the label is laid out tells us a great deal about the investment that we have there. And I just want to share some ideas with you. For example, this is the window that opens to our statement before we've even opened it. This tells us who the custodian is. This tells us who is holding that investment. This tells us whether it's owned by one or two people. It's not unusual to have joint accounts with children or siblings or parents, or any significant other. It will tell you right on the label how it's titled. This clearly tells me that Jane and John Doe are joint tenants, and there's different types of tenancy, but it's something I'm sure that Josh would be prepared to answer if you have any questions there. But this tells us the beneficiary on this account. This is a College America. This is a 529 plan. So this tells us exactly what that investment is and how, who is going to benefit from that. The other type of information that we get is whether the funds are qualified, such as an IRA, or in this case, it's a rollover IRA from a 401k or a simple IRA. It also tells us if it's non-qualified. Now, this has to do mostly with the tax status of it. So is this something that I pay taxes on in its entirety when I pull it out, or do I have to manage a cost basis in which I only have to pay taxes on my gains there? And that's your first clue here. Whenever it says, that it's a qualified account, an IRA or a 401k or a 403b, then the taxation is going to be a bit different than a joint account, or what TOD, which stands for transfer on death, which means that it's not, it doesn't fall under the IRS category of a qualified taxable account. So those things are important to know. And also, again, we're going to refer back to your College America. This one is also very tax specific. So before we've even opened our envelope, we know a great deal about what we can expect to see on the accounts that we open. Now, one thing it doesn't tell us is who the designation is for beneficiaries in a contract. And this is extremely important. Because what you want to do when you retire is you want to go through all of your contracts and make sure that your beneficiaries on your financial documents are who you want them to be. There could be changes as you move into retirement. And we're talking about life insurance policies, annuity policies, even your pension, your investment statements, things of this nature. So you want to make sure that you review that with your financial advisor, if not every time you meet, at least every time you have a major change in your life. So I just want to bring that to your attention. There's two ways actually that your assets transfer upon your death. The first is by contract, and that's exactly what I'm describing here. You can determine, through a beneficiary designation form, how you want those assets to move. So that's a primary and contingent beneficiary. Primary is the first one that would be on the list of beneficiaries to receive the full amount. And then you can have more than one. contingent beneficiary is if something happened to your primary beneficiary. So the second way that you have your assets transfer is by law. And this gets a little trickier because I think people think, well, estate distribution per stirpes is what we call it, and how, it's a very simple way to do that. I actually find nothing simple about this, and I definitely would turn this over to an attorney, because if you don't have an estate plan, then one is created for you. So I just wanted to bring that attention to you. And now I'm going to sweep back into, now that we've opened our statement, what can we learn from that? So let's start with the first page of your statement. It's just amazingly informative. For example, it tells you exactly what your account balance is. It also tells you what the change in your balance was, what your taxes and fees you have been charged on that, what the balance is. The next section, again, we're still on the first page, tells you what you've contributed or taken out of your this account. This is something you want to keep a close eye on, because if you don't remember or we're not aware of a distribution, that is something you want to pay attention to. And this also tells you what your required minimum distribution is. Many of you may be in that age category. Actually, this number should be 72. This is should have been updated. But anyway, this tells you how much you are required to take out of your IRAs at a certain age, or your beneficiary IRAs. And then this tells you what the income that the portfolio drew from. So that actually could be income you could use throughout the year if you chose to do it that way. Taxes, fees, and expenses. What did this account cost me? And that's something people just fly over. It's actually quite important to know what you're paying for the management of your accounts, and how that affects your return. Life and annuity statements are a little more complicated because it's almost like having two sets of books. You have the guarantees, and then you have the actual value. So this, you probably want to meet with your financial advisor on a regular basis and stay on top of this, but this will tell you what your account values are, what you earned, on what the strategies are for investing. There's just a ton of information here. But in every annuity, and I'm not going to be as detailed on this because every annuity is different. And what you want to do is educate yourself on yours and exactly what information you need to pull out of here to make sure everything is on course, which is always our goal financially. So that is my introduction to some pretty basic and fundamental concepts that you could very well master in an afternoon. So I have a question here. Will you be addressing the proposed changes to TOD and whether we should change TOD accounts to something else? That's a very good question, and I was not planning on addressing that now, but please give me a call. Let me just say also, my website, which is lindajblack.com, has a lot of the forms and has a lot of these questions already answered on it. You don't need to log in. You don't have to give me your information. They're just there for your reference and use. So what I'm going to do now is introduce again and thank Josh for stepping in here. Josh, I'm turning it over to you. Can you share your screen and take it from here?
Sure. So again, Linda, thanks for having me. It's my pleasure to be with you all today. And I want to talk about a number of topics that are, I guess, everybody's interested in, but nobody likes to hear about, or nobody likes to not hear about, but deal with, and that is taxes. And so give me just a second here to get my my PowerPoints up and running. All right. There we go. Okay, can we see that? Linda, can you see that?
Yes, I can. Thank you.
Okay, very good. So I don't know how many of you have followed the recent tax changes, but it kind of reminds me of this story that's on the screen a little bit here. And I don't know if anybody recognizes the story in the screen. If you do, go ahead and put it into the notes. But basically, this is an old Aesop's fable. And the story is of the boy who cried wolf. And so Mary's got it there. Thank you, Mary. So in the basic story is there's a shepherd boy who plays a prank on some nearby villagers by repeatedly crying out in fear that there was a wolf going to take the sheep that he was watching. And he did this falsely on a couple of occasions, and then when it finally happened, nobody would listen to him. And so I feel a little bit like that as an estate planning attorney, going to talk to you about some of the tax law changes that were coming. And the reason is that you see taxes have been effectively going down related to when you pass for the past over 20 years. And this is just one example here. We'll talk about a few today, but this is the estate tax. And the estate tax is a tax on what you leave behind when you die or what you give while you're alive. Most people don't realize that if you give a gift, it is subject to a tax. There's a $15,000 exemption each year, but if you give more than that, there are tax implications to that. So anyhow, you can see back in 1997, you could give away $600,000 when you were alive or when you passed without any sort of tax penalties. And that amount kept increasing. And what this means is basically as you, in the past 20 plus years, people were able to give away during their lifetimes when they passed more and more and more, up to its current number, which is almost $11,700,000, almost $12 million. And we, as attorneys throughout this time, have repeatedly warned folks that, hey, taxes might go up. The amount you may be able to leave may go up. So be careful, do your planning. And as we've warned them, it's just gotten better and better and better from the perspective of paying less taxes. There is currently a law that is drastically changed, or not a law, there's a bill going through Congress that is drastically going to change all of this if it gets passed. And President Biden has made it clear that he intends to redo the entire system. So again, I think it's very likely that we're going to see the system change. But I also feel a little bit like that boy who's cried wolf because we as estate planning attorneys have been talking about this so much. The reason that we do think that tax changes are coming is the spending is more than income, and there just doesn't seem to be any concern for balancing the budget in either Congress or the executive branch at this time, like there was 10 to 15 years ago. Whether that's good or bad depends on your politics, I suppose, and I'm not here to comment on those, just to point out that we do expect to see increased taxes coming. So what does this mean? How can you prepare for the additional taxes that are likely going to be coming? And before I jump into that, I want to point something out, because I've run into this issue before where we've had some folks who have expressed a concern that avoiding paying taxes was somehow unethical or immoral. And of course, that's up to you. I'm an attorney. I deal in the legal side of things, not the moral side of things. But I do want to point out that from our perspective, from the law's perspective, and from the history of America and the development of laws, paying the least amount of taxes possible is not an immoral thing to do. And you can see up on the screen there, David Cameron, who was the Prime Minister of England, claimed that Starbucks and Amazon lacked moral scruples by legally avoiding taxes in the United Kingdom. So this is kind of a thing that's being tossed about in our political environment. But Judge Learned Hand, and by the way, that was his real name. He really was Learned Hand. So his mother must have thought he was going to be quite a good student by calling him learned. But he's probably the most famous judge who was never actually on the Supreme Court. Anyhow, this is what he said. And by the way, he's very well respected in the legal community. He said, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose a pattern which will best pay the Treasury. There is not even a patriotic duty to increase one's taxes, right? So you can be very patriotic and still want to minimize the amount of taxes that you are paying. So that's the approach that I take and the approach that I'm going to be taking in just discussing this today. Of course, if you feel differently, the IRS does accept donations. I have confirmed that. If you would just do Linda and I a favor, when you make that donation, just make sure you write for Linda or for Josh on there so they apply it to our account. All right. So just a little favor to ask there. Before we dive into the coming tax law changes and how that impacts you, I want to go over just some basics about taxes. And I realize this is not fun, but it is important that you know this, right? So there's three types of taxes that impact you when you're thinking about planning for getting older, planning for retirement, and planning for eventually passing. There's income taxes, and you all probably are familiar with income taxes. This is what you pay on what you earn. This is the 1040 that you submit to the IRS each year. Those are mostly income taxes, all right? The next is the estate tax, and I mentioned the estate tax earlier. The estate tax is actually two taxes rolled into one. It's a tax on what you leave behind when you die and what you give while you're alive. And it's called a unified tax. And so it is a joint tax on all of those things. And right now, you don't pay any tax on anything that you give while you're alive or when you die, unless you have $11,700,000, and that's doubled for married couples. Just as before you feel too comfortable, if you're underneath that, we have seen proposals reducing that to less than $1 million. And certainly, I think it's very likely that will be reduced to somewhere around $3 or $3.5 million in the next year or so. That's my expectation. So it still may not impact you right now, but it is going to come down. And if you believe inflation is going up, I think we'll be looking at an environment in the near future where a lot more people are subject to this. So it's important that you do understand it. And then the third type of tax that applies is the capital gains tax. And the capital gains tax is a tax on the increase in investments. So if you buy a stock for $100, say you bought Microsoft at $100, it increased to $200, and then you sold it. Although you have not earned anything, you weren't paid a wage, the IRS still charges you a tax on the increase between that $100 increase from $100 to $200. Currently, I did put a bit of a note here, 3 types of taxes. We're seeing a lot of different proposals come through, and some of which involve new types of taxes entirely. So these are the current types of taxes that implicate estate planning. And I use that term broadly, not just when you pass, but while you're alive and as you age. All right, so what are some of the tax changes that we're seeing and that we're expecting to happen, or at least are being talked about? So first of all, the increased marginal rate for all. The marginal rate is how income taxes are paid. And basically it means if you earn $10,000, you pay a lower tax rate, a lower percentage of that $10,000 than if you earn $100,000. And so there's a scale, basically. The more you earn, the higher the percentage rate that you have to pay. And there is a discussion about increasing that. And Brian may go into more detail about these. This has been promised to only impact high earners, but there are some folks who believe it will have a much broader impact. Limited deductions is another change that we're expecting. There's been, right now you can deduct certain expenses from your income. Right, they're discussing limiting that to 25%. So even if your deductions reduce you below 75% of your income, you would still have to pay taxes on 75% of the income. So even if you gave it away to charity, paid it for mortgages, used it for a business, wouldn't matter. 75% of your income is what you pay taxes on. Increased corporate tax for income, which may, again, not immediately sound like a bad thing, but depending on whether it applies to small businesses, could have some serious repercussions on cost and the ability of many small businesses to function or at least keep their prices competitive with the folks like Amazon and other people who can move operations offshore to obtain tax preferred treatment. And I already mentioned that pass-through income and deals with small businesses. So those are some of the income tax changes that we're looking at. Potential estate tax changes. I already mentioned the unified credit exemption. That was that $11,700,000 number. Effectively, what that means is the amount you can give away before you have to pay estate taxes. And we've already talked about that coming down. Biden has stated he will reduce it to 3.5 million for inheritances and 1.5 million for gifts, increase the actual rate. And then one thing that many folks have used over the years is that ability to give away $15,000 to any particular person each year. There is a discussion on capping that at $30,000 total. So right now you could give $15,000 to as many people as you wanted to. So you can give $15,000 to 100 people. And if my math is right, give away $1.5 million in any year, as long as no one person got more than $15,000. And people do use this to give things away. They're talking about reducing that to $30,000 a year is the maximum. And then we haven't really gotten into generation skipping trust. I guess the easiest way to explain that is to say that the estate tax applies only if you give money to your children. If you give money to your grandchildren, then the estate tax is effectively doubled. So if you want to leave $100 to your children, they pay about 40%. If you want to leave that same $100 to your grandchildren, they're going to pay about 80% in tax on those things. And so there's going to be a tweak in how that generation skipping tax applies. And then finally, the most concerning thing to me personally with some of these taxes is that a lot of the structures that we have used for several decades now, there are talk of actually getting rid and not allowing those from a tax perspective anymore. So this would require many folks who have had trusts set up in the past, they would have to redo them if some of these changes went through. I won't get into minority discounts, but if you have questions about that, let me know. All right, so capital gains tax changes that we're expecting as well. And these are some of the most drastic. We're expecting that the increase on capital gains the tax rate's going to increase. So right now, it's around a 15 to 25% rate. And the discussions that we're seeing are doubling that effectively. So again, if you bought Microsoft for 100, sold it for 200, right now you'd pay around $20 in taxes. The discussions that we're seeing are that going up to around $40 in taxes. The step up in basis is probably the most important thing the most important change from an estate planning perspective that we're seeing. And what's being talked about is getting rid of this. And the step up in basis right now I guess you'd almost think of it as a tax break. And so what happens is if you buy that share of Microsoft for $100 and sell it for $200, and then while you're alive, you pay the 20% in tax. But if you buy Microsoft, hold it, and then die and leave it to your children, then they don't, and they sell it for $200 as soon as they inherit it, they pay zero in tax. They only pay capital gains on how much the asset increases while they are alive. And there's been discussion about repealing that. 1031 exchanges being eliminated, new mandatory tax events. I won't go into the details here, but basically this would mean if you owned Microsoft and you inherited an asset which had been increased in value, you would have to pay taxes on it. And again, this may not seem like a huge deal until you think about family farms and small businesses where basically the owners, when they inherit the business, would be forced to pay 40% of the value in the business in taxes immediately, or 40% of the value of the property in taxes immediately, which could cause some major issues. So if you're like me, the idea of all these taxes changes and increasing as you are trying to plan for retirement, right? If you're talking about retiring single and you're looking at retiring with less income than you expected and higher taxes, that's not particularly pleasant. So I thought I would show you this nice picture of 3 of my kids in the middle of a really beautiful lake, just as a way of hopefully calming us all down a little bit. And then we'll jump on to what can you do, right? So what are some of the implications and what can you do practically as you guys plan for this. The big potential that I want to go with here is everything I just shared is none of it's set in stone. We don't know what's going to happen. And if anybody tells you that they do, they're lying, right? Because nobody knows what the heck Congress is going to do. And this is effectively in Congress's court. And it has to go through the House, and then the Senate does their thing, and then there's a reconciliation. And I won't even try to describe how complicated the process has become and all the different options and what's going to happen. It really could be any number of different plans that get passed. And part of that, and even if something doesn't get passed today, it may get passed next year. It depends on the elections. And there's just a lot of moving parts here. So we don't know what's going to happen. And I guess this kind of leads to a question that I like to ask at this point, which is, when is it better to pay more in taxes than you have to? So let me just pause here, and let's assume you're like me and you believe that you want to pay the least amount of taxes that you legally can. And so the question would be, when is it better to pay more in taxes than you have to? Anybody, if you've got an answer, go ahead and throw that in the box there, and I'll give you a few. We'll go over a few different areas here, right? So these are areas where you may want to, well, I guess before I get to that, let me answer this question. So when might you want to do this? Well, one is if by paying taxes now, you can avoid taxes later. That's one. Two is when you are, by paying taxes, it allows you to protect the person who's going to receive the assets, right? Or protect yourself. So if you can pay more in taxes and have more protection or control over your assets, it may make sense to pay more in taxes. There's probably some other instances, but I think this just generally leads to the idea, even though we're talking about taxes here, when we are planning for the future, paying the least amount of taxes, while that certainly is a goal, it should not be the goal. So I do want to give you guys some thoughts in how you think about this type of analysis and this type of situation. How do you think about retirement? How do you think about planning for the future with the uncertainty that exists and with the potential tax law changes coming? I do note that somebody put in a note about the Roth conversion, and that's great. Converting assets from doing a Roth conversion. That is where, yes, you can pay more in taxes now. And the nice thing about converting it to a traditional IRA to a Roth is you can then have those assets grow tax-free. So that great example of when is it better to pay more in taxes than you have to. When you're doing a Roth conversion, because that basically gets you pay taxes now and you avoid paying taxes later. And if you believe that taxes are going to go up, and I do, it makes sense to pay taxes now so you can avoid paying them later. But let's jump into a few principles for how you can think about these different things, and then I'll share some tips for what you can do in terms of how you want to approach different tax structures and things like that. The principles, and somebody asked a question about an IRA, and please remind me, I will make sure I hit that later. Principles in terms of how you think about this, as I'll get to a little bit later, our firm is all about relationships. So when we put together an estate plan, we start with who and not what. We want to know who is important to our clients, what they are trying to accomplish for people, for charities, for causes. And so I would encourage you to think about that as you do analyze and you do think about principles and risk. Do assess your risk comprehensively. Taxes are not the only risk that is out there. You do have other risks. And just a little warning from an attorney, right? Like insurance is only good if the insurance company will pay the claim. So you do need to think about potential risk. And even in terms of what do I do if an insurance company is not going to cover something? If the insurance company doesn't cover this, it doesn't cover that. So you can do a lot of things that are planning for tax purposes. But if it ends up making you subject to other risks, then it's probably not a good idea. Probably the most interesting principle that we're going to talk about here is diversifying for tax risk, right? So a great example of this is somebody mentioned doing the Roth conversion. That may be a great idea if a certain set of facts about the future and certain set of expectations about taxes in the future come true. It may be a terrible idea if they don't. And so we encourage folks, when you're thinking about preparing for the future and taxes, you don't want to have all of your eggs in one basket. And Linda would tell you, if you came and asked her for investment advice, which you absolutely should, when you're looking at investments, you do the same thing, right? You diversify. Well, we're entering an environment where you need to diversify for taxes as well. Be opportunistic. I think that's self-explanatory. When you have an opportunity like right now to do something, you certainly want to do it, and take a long-term approach. As you are doing this, you want to think about taxes over the long term and not try and do a quick fix for today. And finally, don't forget about liquidity. A lot of the tax planning that we're seeing folks do has the downside of making their assets unliquid. What that means is they can't spend it, right? So you've saved a bunch on taxes, but you can't spend the money now. So you have to keep in mind what your needs are going to be in terms of retirement and everything else. I'm not going to go into tremendous detail about all of the tips here, because some of them do get a little bit technical. If anybody has questions, I'll be happy to answer those. But I do want to run through these briefly as some ideas you can look at in terms of preparing for future coming tax changes. And the first tip is to use tax-advantaged accounts. Several of these have already been mentioned, Roth IRAs, but a tax-advantaged account is an account that qualifies for beneficial tax treatment. It is normally tied to a specific use, right? So you can't use money in a tax-advantaged account for anything you want to. With an IRA, you have to use them for retirement. And you have to take it out at certain times. You can't take it out before then. If you take it out before then, there's only certain things you can use it for. Another one is a 529 plan. And this is an account that has to be used for education, right? So you can put money into a 529 plan and it qualifies for beneficial tax treatment. And then finally, donor advised funds are funds that are geared, they can be used for charities. So you get beneficial tax treatment from putting assets into them, but the donor advised fund has to be used for charitable giving. The benefits, by law, these qualify for beneficial tax treatment. And I will note, even though there's a lot of up in the air, it's unlikely that Congress is going to go back in time and change these. So if you put money into one of these accounts now, such as say a Roth IRA, I think it's unlikely that Congress will come back and take that away and make you pay taxes on it in the future. The concerns are, of course, when you use these, they're normally limited to a certain type of use. So when you do put them in there, you can only use it for one thing or a couple of things, and you can't put as much in there as you would like to. Most of them, or some of them at least, have contribution limits. One quick comment here: if you are a little bit more aggressive in your tax planning, 529 plans are a really interesting option, even if you don't need them for education. And I've had several clients who are using them. If you don't use it for education, by the way, you have to pay a penalty, and I think it's 10% to take them out, 10 to 15%. But the clients have said, hey, you know what? That penalty is less than my taxes, so I'm going to pay the penalty rather than have to pay the taxes that are associated with them. Again, you should talk to your accountant or tax professional to make sure that is a right move for you. And I guess it's a good time for that general disclaimer that I think Linda and I would both share, and that is, this is general advice, not specific advice. If you want specific advice, you need to go see your own professional. So that's one, make sure you're using tax advantage accounts. Two, if you are worried about estate taxes, make sure you're using the annual exclusion. And by the way, if you have more than, say, $1 million, I would be at least somewhat concerned about this, right? Because we have seen scenarios, and I should have mentioned this earlier, where taxes can stack. So if you have estate taxes and income taxes, you can end up easily paying close to 100% in the taxes that are owed there. So one other thing you can do is use the annual exclusion. There's lots of complicated ways to do this, but basically, if you think you're going to hit the estate tax, look into giving away $15,000 each year. Lots of different detailed ways to do that: gifts, trust, ILETs, 529 plans, limited partnerships. The concerns with this is it is only $15,000. So if you're trying to protect a large amount of money, is limited and it may go away. Tip number 3, again, I won't go into too much detail here, but you should at least consider a large gift now. If this is only for folks who do have several $1,000,000, there are benefits to just basically giving everything now, taking advantage of the current gifting environment, which allows you to give up to $11 million without any taxes. But there are some negatives to that as well. Another thing that's coming back into favor that we've been seeing recently are ILETs. Again, I won't go into the details here, but it's an irrevocable life insurance trust. It is a way to set some assets aside. Not a great from an investment perspective in terms of it's not going to grow a lot, but it will not be subject to tax, right? So you can take some money, and this goes back to this diversification, take a certain amount of money, put it in this ILET, and know that regardless of what happens, that money will not be taxed. That money is going to go where you want it to go, no matter how much they change the tax structure. At least that's what a lot of us believe. And then the last one I'll mention, a little bit more aggressive strategy, is a spousal access trust. Looks like it's still going to be fairly beneficial here. And this takes advantage of some of the rules regarding the estate tax and income tax to set up a trust for your spouse if you are married. I realize if you're attending a retired single seminar, this may not be something that is an option for you, but it is out there too for something for you all to keep in mind. I'm gonna, I guess, finish up here. And if you would like additional information on these topics or estate planning, elder planning, estate administration in general, please feel free to contact us or subscribe to our newsletter. We send out a newsletter a couple times a month. I may be biased, but I think it's pretty good in terms of providing a lot of content, and we are keeping people posted on the tax law changes and how that's going to impact them. At this point, Linda, I guess I'll turn it back over to you, and or maybe just offer if there's any questions. In fact, I did think there was one question somebody asked: should I take more out of my IRA instead of later? So I'll answer that. If anybody else has a question, feel free to shoot those in. But the answer to whether you should take more out of your IRA really depends on your circumstances, one, and two, what you believe is going to happen about taxes. I think they're going to go up. I wouldn't bet my life on it, but I would bet something on it. And so should you take more out? Well, that maybe. I certainly think that's not a bad strategy, but you should do it carefully and with advice from your financial professional. So go see somebody like Linda, get them to do an analysis for you about what you're going to need, what your expected taxes are going to be, and what it would cost you to take more out now. And if you can convert it over into a Roth, that is certainly a great opportunity. If you want to take it out and do something else with it that's going to have tax benefits in the future, I think that makes a lot of sense. Anybody else have any questions before I turn things back over to Linda?
Josh, actually, I wanted to engage this topic with you. It's a comment that I get a lot from my clients, and I'm certainly not the person to ask, but one of the things that when I suggest that they really need to see an attorney to have their wills updated or created, or medical directives or things of that nature, they'll often state that they have a feeling about whether or not they should have a trust. Someone has advised them to have a trust. Someone has advised them not to have a trust. And often I think people feel like the more money they have, the more assets they have, the more likely they need a trust. So I wonder if you could spend just a few moments defining what a trust is, and what is at what point is it applicable to our estate planning?
Sure, that's a great question. So the easiest way to tell you what a trust is to tell you what a will is. And I think most people have heard the the term last will and testament and are familiar with the concept, but just so we're all on the same page, a will is a document. It's like a contract with yourself. It's a legal document that if you write it correctly and sign it correctly and follow all the requirements in the law, when you die, a judge will enforce it and make sure that whatever you put in there is what happens to your stuff, right? So you can say, I want it to go here and there and all these different places. And the process by which a judge enforces that is called probate. And probate, at least in Virginia, it's not the end of the world, but it does generally take around 9 to 18 months to go through the probate process because, of course, a judge, when they do this, they do it under the auspices of the court system and bureaucracy and everything else, and there are costs associated with that and time. So with that as background, then turning to your question, Linda, a trust is something else entirely. Think of a trust as a fake person that you can create, a fake legal person. You can create a separate fake entity under the law that can buy and sell property. And basically it splits what we normally think of as the rights of ownership into two different parts: the control and benefit. So with a trust, you can have one person who's in control of the trust, or what the stuff that the trust owns, and another person who benefits from the trust. And this allows us to do all sorts of interesting things. Basically, we can set money aside for somebody's benefit, but not allow them to control it. We can do interesting tax things. But probably the most common in the estate planning thing to do with the trust is to use it to avoid that court process that I mentioned earlier with wills called probate. And so what we can do is we can set up this other fake identity here and then have someone effectively give everything they own to this other fake identity. Now, normally they keep control of it. So even though it's technically owned by the trust, the person who created the trust is still in complete, total control of it. But they give it to the trust, and then when they die, they don't own anything. So there's nothing that has to go through that court process. The trust owns everything, and it continues carrying out whatever instructions it was set out to carry out. It was set up to carry out. Those could be as simple as pay everything to my children or my spouse, or it could be as complicated as create some sort of ongoing structure that's going to last for the next couple hundred years. But that setup allows us to avoid the necessity of dealing with the court with somebody's assets when they passed. And that type of trust is called a living trust, or an inter vivos trust, which just during Latin means during life. And the idea is you set it up while you're alive so that you avoid probate and it carries out the instructions. So again, coming all the way back to your question, Linda, why should somebody do that? Well, it really doesn't have much to do with how much they have. It has to do with whether they're trying to avoid probate or not. And that has to do with how, do they want to make things easier for their family when they're gone? And how difficult will probate be? And see, probate's difficulty can vary based on where you own assets. For example, if you own assets in different states, it can be much more difficult. And what types of assets you own. But somebody who is very wealthy and leaving everything to charity could have a very simple estate and not need a trust at all. They could just use a beneficiary designation on an account if that's all that they've got. But it's somebody who doesn't have a ton of assets, but is going to have a very difficult probate, either because of the types of assets or because they've got family members who are going to fight. They may decide they want to use a trust. So we don't have any sort of, set limits. I suppose if you've got less than $50,000 or less than $25,000, we certainly wouldn't recommend a trust, because probate, if you have less than those amounts, is pretty easy. But beyond that, we've done trusts for folks with $100,000 after, not just as a matter of course, but after explaining the different options to them and letting them pick which option they thought fit best for their circumstance, and whether they were willing to pay the increased fee and do the increased work to avoid the difficulties of probate later.
Excellent.
Does that answer your question, Linda?
It does, exactly. Thank you very much. And the second most common question I get and I try to discuss it with each of my clients, is the situation with a medical directive. And I have been under the impression that if you have children who are adults but are unmarried, it's wise for them to have a medical directive. If something happens to them, they can appoint who gets the medical information. It's not always easy for parents to get information on their children if they're adults, if they don't have that type of document. And I also want to point out that for somebody who's newly single, the medical directive, I always advise them to review it, to make sure that if they have defaulted to a spouse, and that spouse is no longer with them, they may have to or would certainly want to reappoint someone. Would you concur with that, or do you have any other thoughts on that? Am I correct in what I've been telling people?
Absolutely.
Okay.
I would go a little bit further. I would say that anybody over age 18 needs a medical directive. And I think there's some confusion that happens because people assume, one, I think people just don't think about what would happen if they go into a hospital or facility. And thank goodness most of us haven't had to deal with that personally. Or even when they do, they don't realize the power that a directive can have. And I frequently hear from somebody, well, the doctor talked to me, I feel like things were okay. And this happens with the spouse, right? Well, my spouse they'll be able to talk to the doctor, and they're right. The doctor will probably talk to you, but the doctor will not be able to listen to you in regards to certain things if you don't have that directive. And where it really comes into play is with ceasing care. And so doctors, Hippocratic Oath, the medical institution, their goal, their primary default method is keeping somebody alive as long as possible. And so if you want to end that, and many of us don't want to be kept alive in certain scenarios, then having that directive is really the only way to do it. I am aware of some instances where folks have been able to cut off care without it, but in my experience, it's getting more and more difficult as hospitals and doctors get more and more sophisticated and become aware of the law. And from a legal perspective, you have, whether you're married, child, blood brothers from birth, whatever, you've got no rights without that document. Doesn't mean they won't talk to you, doesn't mean they won't listen to you, but it does mean they shouldn't allow you to make certain decisions. And we're seeing that more and more. So again, I would say even people who are married over age 18 need an advanced medical directive. And if you're newly single, absolutely. You probably don't want the ex being the one who gets the call to make decisions about what sort of treatment you're going to get.
Thank you so very, very much for all of your valuable information, Josh. You're a huge resource to me, and I very much appreciate your time.
Absolutely. Thanks for having me.
I would like now to introduce Brian Kling. Brian, are you able to pop in here? You should have. There you are. Hooray. So Brian and I have worked together for many, many years, and he is absolutely my go-to person for tax information. As a matter of fact, Jan Heidenbarber, who I had introduced to you all at the beginning of this presentation, and we talked about their proactive approach to tax laws and strategies. That's all very good, and I very much appreciate and respect that. But what I like best about Jan Heidenbarber is they answer the phone. So I can actually talk to somebody whenever it's a pressing issue for me. So they're very, they appreciate my anxiety at times. So I will just publicly thank you for that. And it probably embarrass you a little, Brian, but I do appreciate that.
I'm hard to embarrass.
So I would like to turn it over to Brian. Thank you very much. Did I miss anything in the introduction?
No, thanks. I appreciate that, Linda. Appreciate the introduction. We try to pride ourselves on the service aspect of things. I mean, anytime I meet with a new client, I think I've told you this over the years, that generally speaking, what we're doing here is not rocket science. So it means a lot to people to just have someone that's responsive whether it's email or telephone calls or whatnot. So am I able to share my screen?
You are, yes.
All right. Is that, can you see that, my
That
big
is
smiling
perfect.
face?
Yes.
All right. So my name is Brian Kling, obviously. This is my contact information. Linda asked me to come here this afternoon and speak to you folks about taxes as you're entering retirement, or as you're in retirement, some things that you need to be aware of. When is an appropriate time to reach out to an accountant? Yeah, there's a lot of things I'm not going to touch on today. I mean, as you're probably aware, it's one of the reasons that you're probably here today is that the tax law is very nuanced and voluminous and constantly changing. So I'm going to hit a lot of high points, but you know, please put your questions together. I'll answer as many as I can today, but whatever we're not able to get through, you know, send them to Linda, she'll get them to me, or you can send them directly to me, and I'm happy to get back to any of you with any of your questions that you may have after the presentation. So this is just my little note here that basically what I'm saying here is for federal tax purposes. They could change. Some things likely will change with the impending law change that Josh was talking about, and not everything I'm going to tell you here is going to fit with everyone's situation. Everyone's situation is completely different, typically from one person to the next. So there's several highlights that I'm going to touch on today. Do I need to file a tax return if I'm no longer working? That's a really common question that we get from retirees or those that are thinking about retirement. Is my income taxable or not? How much of my Social Security benefits that I'm going to be receiving are going to be taxable? I'm thinking about selling my home. What am I going to be looking at as far as the tax liability goes on the sale of the home? And what can I do to reduce my taxable income? You know, like Josh was saying, none of us want to pay more tax than we have to. So, you know, there are things we can do to reduce our taxes, and we'll go over a few things there. Also, as a lot of people enter retirement, if they're, you know, they may be renting or they've paid off their mortgage and some of their expenses may be lower that they would typically itemize. Do I take the standard deduction or do I itemize now? We'll go over that real quick. And then probably the most frequent question I get from retirees is, should I make estimated tax payments? I'll cover that. So first thing, do I need to file a tax return? Generally speaking, I tell everyone, yes, you should file a tax return, especially if this first thing actually reads a little funny. I caught this when I was going through my review this morning. If tax was withheld from any source of income and you could be eligible for tax credits, only available if you file. So for example, let's say you had some Social Security income and you had some tax withheld out of the Social Security income, but you've got no other income. You would want to file to get that tax back that was withheld from the Social Security income. There are some tax credits that are only available if you file. Most recently, the big thing has been the recovery rebate credit, the stimulus payments that many of you probably got, but some probably didn't because they hadn't filed a tax return because they didn't have a filing requirement. That most recently has been the biggest reason that we've seen that people have come in to file their tax returns that hadn't necessarily needed to file in prior years. If your filing status is single and you're younger than 65 and your income is less than $12,400, absent any of the other things above, you wouldn't need to file. 65 or older, the income threshold rises a little bit. And if you're married or a qualifying widower, meaning a qualifying widower would be someone that typically the spouse passed in the 2 preceding years, the the exemption is the same whether you're married, filing joint, or qualifying widower, and that's typically double the gross income thresholds of single, whether you're 65 or older than 65, under or older. So is my income taxable or non-taxable? Generally, you can assume that it's taxable unless it's specifically exempt by certain law. Compensation for services, whether you're traditionally employed or you are self-employed. Most of your dividends, interest, any rents that you're receiving on rental property potentially, and then of course capital gains. There's a whole set of rules. I could do a whole entire presentation just on capital gains, especially how it could potentially change here in the next couple of months. Generally speaking, they're all taxable. If your income is below a certain threshold, it's possible that your capital gains are taxed at a 0% rate. And of course, I'm talking just, this is for federal tax purposes. I'm not talking about anything for the state of Virginia or any other state that might be applicable here. Generally, unemployment compensation is taxable. This past year, there was an exemption for, I think it was $10,000 for federal tax purposes that would be not taxable. But I think that was a COVID-related exemption. Most of your retirement plan distributions are going to be taxable. Early distributions are going to be subject to a 10% early withdrawal penalty if you're younger than 59 and a half. It is important to understand where you're withdrawing your retirement from. They all have different tax attributes, whether it's a 401k or your IRA or what have you. It's important to know because they could be different significantly. Some of those also have a required minimum distribution. That requirement is now starts at the age of 72. However, if you turn 70 and a half before January 1st of 2020, then you've got to revert to that law, to that rule, the 70 and a half rule. How much of my Social Security is taxable? This is completely income dependent based on everything else that's on your return. But I can tell you that it will never exceed 85% of the benefit that you receive. And that's the biggest point to take away from this. I mean, generally, Social Security is going to be taxable to a certain extent. The threshold to get up to the 85% of benefits taxable is pretty low. So more than likely, the Social Security is going to be taxable, but never more than 85%. And for Virginia purposes, I know I wasn't going to talk about Virginia or the states, but it's Virginia does not tax Social Security. So you're thinking about selling your home or you've sold your home. A couple things to think about in that process is how long have you lived in the home? That's the biggest thing. I assume if you're in retirement, you probably have lived in the home for at least 2 of the last 5 years. That's the first test. But then you're also going to want to consider, all right, what did I pay for the home? And we would want to include not just the original purchase price, but any major additions and remodels that we've had since then. We need to factor in if the home was ever used for business and potentially we had a depreciation deduction against the home that we took that could reduce our cost basis in the property. And if you're selling the home after a spouse has passed away and you had owned the home jointly with that spouse, you'll likely get a basis step up. And what I mean by basis step up is, for example, you bought the house for $300,000. And today it's worth $1 million. Or at the time that your spouse died, it was worth $1 million. You get a basis step up to half of the fair market value when the spouse died. So you're going to get a basis step up to $500,000. You're going to add that to half of what you paid for it. So you and your spouse came in, you bought it for $300,000. Half of that's $150,000. Half of the basis step up is $500,000. Your new cost basis in that property is $650,000. So we combine that and we look to see, all right, well, how much is my gain? And in this case, let's say you're going to sell it for $1 million. Back up, tax basis is 650 now with the basis step up. You have a $500,000 gain exclusion before any of your gain is going to be taxable. So in this particular case, you wouldn't be subject to any gain or any tax. That doesn't mean you shouldn't report the gain on your tax return. I've seen a lot of times where the settlement agency, especially for sales where they're over $500,000, they'll issue a 1099. The taxpayer is understanding that my gain wasn't taxable. Months down the road, they get a nasty gram from the IRS that says, hey, we have this 1099 that was reported to us for $500,000 worth of proceeds. You owe us hundreds of thousands of dollars. It's typically very scary written notice that we've responded to dozens of these over the years. When in reality, then we have to sit down, we go through the calculation for the IRS in response to the notice and tell them, no, the gain was actually not taxable and was completely excludable under the $500,000 gain exclusion. Now, if you're selling the home years after the spouse died, or you are single and you bought and sold this home as a single individual, your gain exclusion is only $250,000. So how can I reduce my taxable income? These are the typical things that we see with a lot of retirees. Still making IRA contributions, subject to certain taxability or taxation limits, gross income and taxable income limitations. If you've converted to being self-employed, many times your health insurance that you're paying can be deductible. You could make contributions to these other various retirement plans, whether they're SEP, simple, other qualified retirement plans could go a long way to reducing your tax liability. If you've had a withdrawal of savings that was subject to a penalty, that's deductible. And for those of you that are divorced and paying alimony, that could be deductible. Although most recently, that's been changed since 2018, and it's not likely deductible if the divorce was after 2018. But along the same lines, if you're a recipient of alimony, that income is not taxable typically after 2018 if you're the recipient, unless it was a divorce a divorce agreement that was passed before that law in 2018. So should I itemize or claim the standard deduction? It depends on your filing status, your age. There's an additional deduction if you're legally blind. These numbers that are on this slide, they typically adjust for inflation each year, but you're typically talking a few $100s each. Are you married but filing separate? There's a lot of reasons that people do that. Sometimes filing separate from your spouse does result in a lower tax liability. It's very rare, but sometimes it does. Sometimes people file separate if they're in the middle of a separation. But if you choose to file separate and your spouse that you're filing separate with, or they're filing a separate tax return, if they itemize, you must itemize. And that can have significant impacts on the individual that has the lower deductions. Otherwise, your standard deduction, if you're single, is going to be $12,400, and double that if you're married filing joint or qualifying widower. Once you turn 65, each taxpayer and spouse is going to receive an additional $1,300 above those two numbers above, $12,400, $24,800 plus $1,300 for each individual on the tax return. Also, if you're under 65 and you're blind, you also get the $1,300. Sorry about that. Itemized deductions. So typically what we see for retirees is that their biggest deduction is likely going to be taxes and potentially charitable contributions. If you've got a mortgage that's paid down, that's going to significantly lower the itemized deductions you may have. You're able to deduct your medical expenses, but many times those medical expenses have to be typically extremely high in order to be deductible. As you can see here, they must exceed 7.5% of your adjusted gross income. So let's say you've got $100,000 of adjusted gross income and you've got $6,000 worth of medical expenses. Well, none of them are going to be deductible because that threshold, 7.5%, $7,500, you haven't exceeded it. But let's say you've got $10,000 worth of medical expenses. Then we can get a deduction, but we can only get the deduction, the portion that's above the amount that we've already had to exclude, the $7,500 portion. So we're only able to deduct $2,500. So in this example, let's say we've got medical expenses of $2,500. Let's say we've paid down our mortgage a good bit, and we've got, I don't know, let's say we've got a couple grand in mortgage interest. Let's say it's $2,500 for the ease of the math. So we've got real estate taxes, personal property taxes. They're going to be capped at $10,000. So between real estate taxes, the little mortgage we've got, and the medical expenses we're able to deduct, we've got $20,000 worth of deductions. And let's say this year we didn't make a whole lot of charitable contributions. So in that particular case, if you're married, your standard deduction is $24,800. Well, just with your medical expenses, $2,500 in mortgage interest, and we're capped at $10,000 here, I've only got $15,000 worth of deductions. So I'm going to claim this bigger deduction. Now, what I see people do all the time is, and they potentially lose the ability to deduct their charitable contributions, is they'll make a relatively large contribution sometime during the year, but they fail to factor in whether or not their itemized deductions are going to be higher than their standard deduction. So in this example, I've got $2,500, $2,500, and $10,000. So I'm at $15,000 in deductions before I've made any charitable contributions. And let's say I made a $5,000 charitable contribution, thinking I'm going to get a nice tax deduction for that. Well, I'm still below the $24,800 if I'm married filing joint. Of course, the math changes significantly if you're single, and that limitation is much lower. But it's something to factor in and something to think about if you're making these charitable contributions, or if you're paying mortgage interest. If you've got a small mortgage and you continue to keep the mortgage because you're thinking, well, I'm able to write off the interest, make sure you're actually writing off the interest and you're not claiming the standard deduction, because it's ultimately the higher deduction, because then you're not getting any tax savings from the mortgage interest. Okay, before I move to estimated tax payments, I guess one thing I wanted to talk about let's go back to the charitable contributions. One thing that we see people do is they'll take a lot of people have the required minimum distribution when they reach 70 and a half or 72, depending. But they don't necessarily need the money, but they want to make charitable contributions that could reduce their income. They claim the standard deduction. What do? Well, they can have their distribution from their IRA or their qualified retirement plan directed directly to the charitable organization of their choice. So let's say in this case, the required minimum distribution is $5,000. They are below the itemized deduction threshold, so they're claiming the standard deduction. So they're losing the value of the charitable deduction. Well, if they choose to have a qualified charitable distribution directly out of their IRA, both to satisfy their required minimum distribution, and what it does is it reduces their taxable income. So you don't get a deduction, so to speak, for the charitable contribution, but the $5,000 IRA distribution that you receive that would normally be taxable to you becomes non-taxable because it was directed to the charitable organization. All right, estimated tax payments. Again, like I said earlier, this is the most frequent question we receive. And a lot of it is because, you're transitioning from being traditionally employed to being retired, and your income is coming in the form of Social Security or taxable income such as dividends, interest, and capital gains, or your pension and retirement income. And it's easy when you're traditionally employed and your employer is taking out your federal and state income taxes on a regular basis. It's kind of out of sight, out of mind. But when you don't have that anymore, what are you supposed to do? Well, the rule is, if you expect to owe at the end of the year more than $1,000 when you file your tax return, and your withholdings from your qualified retirement plan distributions and any other income that you have are going to be less than the smaller of, I'm going to leave this up here for a while because this is kind of a difficult concept to grasp. But if they're going to be less than 90% of the tax shown on your current year return, on your 2021 tax return, or 100% of the tax shown on your prior year return, you're going to be required to make estimated tax payments. Now, what does required mean? It means that if you don't, there's going to be you're going to pay an estimated tax penalty on when you file your taxes. And typically, any sort of penalty freaks a lot of people out. Some people say, well, I'll keep the money as long as I can. I'd rather keep it in my bank account as opposed to giving it to the IRS any earlier than I need to. I'll pay the penalty. Typically, if your tax is thousands of dollars, you're typically looking at tens of dollars in penalties, sometimes up to hundreds of dollars. That's sometimes worth it for some people if they can keep the cash in their portfolio. Right now, the way the markets are, I mean, Linda can speak to it a lot better than I can. It might be worth it to keep it in your portfolio as opposed to taking it out and sending it to the IRS. They don't pay you interest when you pay them early.
Brian, this is such a good point. And I know that we're getting some questions on this, but we are, for example, our checks from IRAs to charity count as a direct transfer? That's a great question. Unfortunately, we're almost out of time though. So I wonder if you can, quickly respond to that, or perhaps provide a resource for that.
Do checks from IRAs count as a qualified distribution? Checks
from IRAs to charities.
If it goes directly to the charity, yes. The taxpayer cannot, I'll say, quote unquote, touch the money. So if the check has come to the retiree and then they deposit it and then then send the money to the charitable organization, you've kind of blown the qualified charitable distribution.
Gotcha. Well, that's good, and that sounds like something they would need to make sure of if they spoke to their advisor.
Yeah, well, it needs to be a direct transfer, and that can be in the form of a check or some sort of electronic funds transfer.
Excellent. Well, thank you. And
yeah,
so I hate to do this to you.
No, that was it.
That was it.
I was
awesome.
Yeah.
All right. Well, you squeeze it all in. Thank you very, very much. It was excellent information, all to the point, and I so appreciate it. So I just want to again thank you, Brian, very, very much. I hope to coerce you into speaking again in the future. But I want to say to everyone, thanks very much for tuning in. Our second class, which is next week, we're going to cover income strategies. What's the best way to withdraw from your portfolio? And that will actually tap into taxes as well. So I will have Brian on speed dial. But housing considerations, aging in place, and housing options are going to be our topics next week. Third class, we're going to talk about lifestyle changes and benefits actually of retiring and having all of these choices, mental health, wellness, and your legacy. So those will be the lineup for our next two classes. Thank you all very, very much. And I look forward to seeing you next week.